Good evening, Doctor.
Good evening, Mr. Matibula. How are you?
I'm good today.
Yeah, we are back again.
Yes, we are back, and I'm glad we are still in a good health. I'm assuming that we don't have any challenges.
Yes, I hope
Yes,
so.
and good evening to all the students, and thank you all for managing to connect. And right now it is exactly 5 o'clock. We can start.
All right. Okay, students, you are welcome back to our workshop this semester. We are starting with lesson unit 4, which is inventory. I will quickly share the study guide and we will start off immediately. Okay, so we're starting with lecture unit 4, inventory IS 2. My duty here is to make sure that you have a clear understanding of the concept. I know that you will have been taught on your regular classes with your lecturers, but the role of the facilitator is to ensure that you have a deep grasp of that particular concept of that subject. So I will try as much as possible to ensure that, and I will also solicit your support that we should try to engage. Please, when I'm discussing particular issues and you're not clear about it, quickly raise an objection and so that we can clarify it on time. That is why you are here. Okay. I want to also apologize for my voice this evening. I'm trying to recover from flu, so I hope that you'll be able to hear me well. Okay, so we are going to discuss inventory, and I will try as much as possible. Let me start from, I know that maybe, I don't know where you are right now with your normal classes, but let me see how we can be able to do some introductions about it, and we'll get starting with some of the um, exercises which will give you deep understanding of what you are supposed to know about inventory as regard to your curriculum and as also regard to International Financial Reporting Standard. Okay. All these learning outcomes, the learner should be able to account for inventories and disclose it in annual financial statement in accordance with the requirement of the International Financial Reporting Standard. So we will try as much as possible that after this class, you should be able to do this. You should be able to account for inventory and able to disclose it in annual financial statement. Okay. These other details, you can go through it. Let me say, we can try okay, let's start from the definition of inventories. Maybe it will just serve as a reminder of what you will have known about inventory. So inventory is, include both tangible and intangible asset. Inventory is recorded in current asset in our statement of financial position. So it's an asset. It can be tangible and it can be intangible. And what is inventory per se? Inventory is what is held for sale in the ordinary course of business. So it is what, in the ordinary course of a business, what you are holding on, either you are keeping in your warehouse for purpose of selling them. And that is the business that you are doing, okay? If you are a car dealer and you have cars in your dealership, in your warehouses, that car becomes your inventory because that is the asset that you are keeping for purpose of selling them. That is the normal business that you are doing. Then it can also be in the process of production for sale. So it might be some materials that you have to first of all feed into a production process before it becomes a finished goods. Okay, that will also classify as inventories. It can be work in progress. It can be raw materials. It can also be finished goods. Okay. So these are various definitions. It can also be in the form of material that is to be consumed, excuse me, in the rendering of services or process of production. So these are definitions of inventories. Okay, it's what you can read and also research about to have details of what inventory is. So this is inventory. We have an example here that will give us a clear understanding of what inventory is. For the example of 4.1 says, how will the newspaper be classified if a newspaper seller utilizes a vehicle to distribute newspaper to a customer? Okay, you see this question now. How will the newspaper be classified if a newspaper seller, that is the business that is doing, is a newspaper seller. So, but it's using a vehicle to distribute that newspaper. So why do you classify that newspaper? To him, that newspaper is an inventory because that is what he's doing. That is what he's selling. So when he has, a stock of that that newspaper in his warehouse for purpose of selling them, it becomes an inventory. It's an inventory to him. But if he uses vehicle to distribute it, that vehicle is not an inventory. If that vehicle is just an asset in his business, okay, it's also a form of an asset, but it's not an inventory because it's not selling vehicle, it's selling newspaper. So I think you should be able to understand what inventory is now. So if we look at the suggested solution, it says that only the newspaper will be considered inventory if the newspaper seller utilizes a vehicle to distribute newspaper to customers because newspaper is held for sale in the ordinary course of business. That is the business that is doing. It's a newspaper seller business. Okay. So, but the automobile, which is the vehicle, will be considered as an asset. That is the other asset. The other asset. Okay. Then we'll now talk about measurement of inventory. How do you measure inventory? Okay, inventories, measurement is defined as the process of establishing the quantity of that inventory in monetary terms in the financial statement. When you are saying measurement of inventory, if you have a lot of inventories in your stock, you are not going to say 1, 2, 3, 4, 5, 6, 7, and you put, okay, there are 7 in number, and you put that 7 in your financial statement. No, you have to quantify it in terms of monetary value. So that is talk about measurement. So when you are measuring you want to say, okay, this 7 item, what does it cost? How do you ascertain the value of that stock? So that is talk about measurement. So and IS 2.9 says that inventory are always measured at a lower of cost and net realizable value. So this is how you measure your cost. You measure at a lower of cost. That is between the cost of that item and the net realizable value. As we go on, you understand what is net realizable value is that what is the market value of that item now. Okay, if you are selling a car, for example, you are a car dealer. Now, how do you measure those cars? So say you will measure it in terms of the lower of the cost and net realizable value. If the cost is 20,000 rand, and if you want to sell that car now, how much you will sell the car in the market? So the value that the car costs in the market at this present moment is what is referred to as net realizable value. So when you are measuring your stock, you have to compare that to prices. Okay, that's two costs. The actual cost of that vehicle, and if you are selling the vehicle now, what you are going to realize from it. So you compare the two. Then the lower of that two is what you will use to, to measure your inventory. That is what IS 2.9 says. Then inventory can also be measured at a standard cost or retail method. This is another, as a standard cost, that is as a predetermined cost. So that is also follow some logic. It follows some where you talk about FIFO, weighted average cost and others. We are going to get to that as we go on. Okay, so let's look at the cost of inventory now. What are the components of cost of inventory? What are those things that comes together to form the cost of inventory? What are those elements that constitute the component cost of inventory? So the cost of inventory comprises of the following: the purchase cost, that is the purchase cost, the cost of ordering that particular item. So that cost is there. The conversion cost, when you are talking of production processes, okay, if you buy a raw material, for example, and that raw materials must be processed to become finished goods, okay? So the cost of buying that raw materials, then you will feed that raw materials into the production process. You will also the money there before it can becomes a finished goods. So that's what is called conversion cost. Then we have other costs. Other costs you incur in bringing the inventory to the present location, and other conditions other than those subsequently recoverable by the entity. We will see the details of that one shortly. Okay, so other costs. There are other costs that is traceable to that particular item. So your purchase cost, your conversion cost, your transport cost, your insurance, freight, and all the other things that is, that is traceable to that particular cost will be put together to determine the total cost of that inventory. Okay, so here it talks about the details of that. Hello. Okay. Yeah. So this talked about try to explain the details of those components for us. We have the purchase costs are dealing with the conversion cost in B and other costs in C. So here we talk about the purchasing cost. So the cost of purchase of inventory comprised of the following. According to paragraph 11 of IS2, we have the purchase price. The purchase price is the amount of money that an entity pays, cash or in agreed terms for the finished goods or raw materials. So that's the actual money you use to purchase that item. Then we talk about import duties. If you are bringing the goods from abroad, you have to pay import duties at the point of entry into your country. Okay, so that is part of the cost of that inventory. Then transport cost. This is the one you incur, locally between one place or the other, either from the port to your warehouse. The transport cost must also be added to the cost of the inventory. Then the handling cost. If there are no other handling cost, there's any packaging or whatever, is there any extra money that the entity pays to the supplier for getting finished goods or raw materials ready to be delivered? So any other money that is expended, to make sure that that particular goods gets to your warehouse in a right condition. Okay, so those those costs will also be added as part of the cost of the inventories. Then any other cost directly attributable to the acquisition of that inventory. So any other cost, like any trade discount or rebate are deducted from the original cost. So if you are buying the particular items at a discount, you also take away the discount so that you have the exact cost for that item. Okay. Then when inventories are purchased on deferred settlement, for example, if you are not paying cash immediately and you are going to pay over a period of time, when payment involves a deferred payment, then you'll be talking of the financing element. Interest will come in. Okay. If you are not going to pay immediately, maybe you are going to pay over a period of time, then the owner of the fund will have to charge you interest. So that interest element will also be recognized as expenses over a period of time that you are to pay. So these are those things that just to take note of in case you see them in your questions, and you'll be able to apply them accordingly to determine the cost of a particular inventory. Okay, so let's look at this example. It will be able to also show us some of those things that we have talked about. Let's look at this example 4.2. Okay, so Cycle Pro Limited, a bicycle retailer who operates in Pretoria, ordered 1,500 new Western flyer frames from Singapore for their exhibition to be held at the Rand Show. Okay, so the Western flyer frames were received from the supplier on 1st of February 2020. The invoice price of the Western flyer frame was 2,500 Rand each before a trade discount of 5%. Okay, so there's a trade discount of 5% and it's payable on 31st March 2020. The year end of Cycle Pro Limited, a good in transit insurance was taken out for a non-refundable of 1,500 deposit for delivery of the items of Cycle Pro Limited to Cycle Pro Limited warehouse. So there's an insurance, a transit insurance that was taken. Remember that any cost that you incur that is traceable to that particular items, which ensure it to be delivered to the warehouse of the buyer in a right condition, in a good condition, such expenditure will also be considered as part of the cost of that inventory. So you just have to note that. Okay, so en route to Pretoria, an attempt was made to hijack the delivery truck, and 25 of the Western flyer frames were irreparably damaged. So a claim was submitted to the insurance company. So the following costs regarding the purchase were freight and insurance, excluding 1,500 above. Cartage to Pretoria, which is the transport to Pretoria. Then the custom duty. So it means that the goods is coming from abroad. If you want to pay custom duties coming from abroad. So these are the, those costs that pertaining to that purchase. Okay, and the question is saying, calculate the cost of the inventory. Calculate the cost of the inventory. Okay, so this is, some questions, you see that you want to calculate the cost of that inventories. So if we go, let's go over the questions again. We see that the Cycle Pro Limited, a bicycle retailer operating in Pretoria, ordered 1,500 new flyers framed from Singapore for their exhibition to be held at Rand Show. The Western flyer frame were received from their supplier on 1st of February. The invoice price of the Western flyer was 2,500 each. So 2,500 each for 1,500 order. I mean, that is the total numbers of items ordered for is 1,500 Western flyer frames at a cost of 2,500 each. but there's a discount of 5%. There's a trade discount of 5%. Like what we we were told, before now that, any discount, you have to deduct the discount. It shouldn't be part of the cost because it's not a cost to you. It's like an income to you. Okay, then we also see a good insurance here. I mean, non-transit insurance here. And we also told that there was an attempt to hijack the delivery and 25 of the Western Flyer frames were irreparably damaged. Okay. And the claim was submitted to insurance company. So we were also told of the other components of the purchase. Other cost components of the purchase were also highlighted here. So let's see the suggested solutions, how you go about it. Because the question is asking us to calculate the cost of the inventory. Now, the component we saw the other time, we talked about the purchase price. The purchase price here is that the total number of frames is 1,500 and the cost is 2,000. The cost per one is 2,500. So the total purchase price is 3,750,000. Then remember that you have to take care of the trade discount. Okay? We were told that the trade discount is 5%. So if the total cost you have to pay is 3 million, excuse me, 3,750,000, then you allow 5% trade discount. So you remove 5% from there. So it means the purchase price, the price you actually paid as a purchase price is 3,562,500. So we now consider the other attributable cost. Okay, we now consider the other attributable cost. Freight and insurance. Freight and insurance, we were given in the question, 150, 500. The cartage to Pretoria, we were given. Custom duties, we were given. Okay, so freight and insurance, we were given. The cartage given, the custom duties, we were given. These are all called direct attributable costs. Those costs that really affect that particular item. Then remember, we still have non-refundable deposit. This is freight and insurance. Okay, freight and insurance. Maybe this one is taken because the goods is coming from abroad. But even within the country now, they also take good in transit insurance. So you also bring it in here as part of the cost of that inventory. Then remember that when they are on their way, there was an attempt hijacking where 25 Western Flyer frames were damaged, irreparable damage, 25 of them. So when you are now calculating the cost of the inventory for the purpose of reporting it in your financial statement, you have to make sure that the value of this 25 have to be taken out, okay, because it's already damaged. So it's damaged already. So that is why here, when you are putting the cost together, you also consider the damaged one, which has to be written off, okay? So you have to determine that value. You can see that the actual value the actual value of the actual purchase price is 3,562, okay, 500 for 1,500 frames. So for you to discuss, we have to determine the cost per unit. The cost per unit here is 3,562 divided by 1,500. It will not give you cost per unit. So when you know the cost per unit, you multiply by the unit that damaged, which is 25. So you'll be able to give you that the value of the damaged frame is 59,375 because you divided the total purchase price divided by the number of frames. So it gives you the cost per frame. And when you know the cost per frame, you will now be able to determine the cost of the 25 frames that were damaged. Okay, so that is why how you arrive at 59, then you have to take it out. So it means the total cost of the inventory will now be all of these less 59,375, which will now be 399,125. And for you to determine the price per unit now, it will now be, because 1,500 minus 25, this is the damage 25. So the value, the number of frames you are having now is 1,475. And the total cost of the inventory now is 399,125. So the cost per unit of that inventory you are having now will now be 39995 divided by 1,475, which will give you 2,711 per a frame. So this is how you determine the cost, from the questions of this format. Okay? Is there any question?
Yes, sir. I have a question.
Okay, go ahead, Jovian.
I now missed that part where you mind scrolling the screen down, please?
Up.
I now missed that part where I know missed the part now where you explained we divided by 1,500 and you multiply by 25. Can you just go over that part again, please? I missed that part.
Come again, you said?
There where you calculated the damaged goods. We took the cost divided by 1,500 multiplied by 25. Can you go over that part again, please? I missed that part. Can you explain to me why multiply by 25?
Okay. You know that the total frame ordered for is 1,500.
Correct, yes.
Okay. Now, out of this 1,500, we were told that because of hijacking, 25 of those items were damaged.
Yes.
Okay. So in your calculation, in determining the cost of the inventory, you have to remove the cost of this 25. Because it's already damaged. You have to remove, it's no longer part of the stock. It will now be an expenses in the profit and loss. Our inventory is a line item in the statement of financial position. But damaged stock will be written off. So it's going to be an expenses. So to determine the cost of this 25 is for you to determine, okay, what is the cost of each of the frame? Now, how do we determine the cost of each of the frame? Is what we have said here. You know that our purchase price is 1,500 multiplied by 2,500. So ordinarily, the cost of each frame is 2,500, according to the question.
Okay, so just to clarify, you took the full amount, that 3 million, you divided it by 1,500 units, and you multiply. Can you just look at the calculation one more time?
Jovian, ordinarily, the cost per unit has been given in the question to be 2,500. But because you are now considering the trade discount, so you remove the trade discount. The trade discount is that the supplier allow you to pay less by 5%. So when you take the trade discount, so the actual money you pay for those frame is 3,562,500.
Yes. Okay, I missed the trade discount part. Thank you so much.
Yeah.
I appreciate it.
Okay, so this one divided by 1,005 now will now give us another cost per unit, which we now use to multiply the 25. Okay, any other question? All right, thank you, Jovian.
On my side.
Yeah. Any other questions before we continue? Okay, so this is how we determine the cost here. Then let's move to another one, conversion cost. that is for material that is going to go through a production processes, let's look at how we deal with those costs also. Okay. So conversion costs, these costs are incurred in the changing of raw materials into finished goods by manufacturing entities. So these are costs incurred in the factory and directly related to the unit produced. Okay. So we have direct labor and production overhead are concerned with the production of one product. However, joint cost, main and byproduct are concerned with the production of more than one product. So we are going to deal with it one after the other. So when we are talking of direct labor cost, these are costs incurred by entity for the work performed by employees, such as wages and other company benefits. So these costs must be directly related to the manufacturing of the finished goods or the provision of services in the factory. So when those raw materials are fed into the production processes, there are people that work directly on converting that raw materials into the finished goods. So their wage are referred to as direct labor cost, and it must be, charged to that particular inventory by the time it becomes an inventory, either in the work in process, work in production, work in process level, or at a finished goods level. So that will be charged, will be considered as part of the cost to be charged. Then we also have production overhead. These are the costs of running or operating of an entity that are believed to be caused by or result from the process of making finished goods in the factory. Okay, these costs are not, the production overhead costs are incurred in the manufacturing process, but do not form part of the direct materials or direct labor costs. For example, depreciation of a production machinery. Okay, you know what is a depreciation? Depreciation is the wear and tears of the machineries, right? Of the machineries. So when you depreciate the machineries, depreciation is also an expense that will be charged to P&L. So that is not direct materials, it is not direct labor, but is also an expenses that need to be considered, when calculating the cost of that particular inventory, either work in progress or finished goods. Okay? So that is production overhead. We are going to look at it when we consider one of the examples. So then the correct allocations of overhead cost is essential to ensure that the cost of inventory is accurate. So the way you allocate that inventory, that production overhead cost is also very, very, relevant to the correctness of that cost of that inventory. So there are distinguished these are distinguished on whether they vary with the production. We call it variable overhead or not, which is called fixed overhead. If that cost is variable, okay, to the unit produced, then we call it variable overhead. That is, if the cost grow as the unit produced, then it's variable. But if the cost is fixed, irrespective of the irrespective of the unit produced, then we call it fixed overhead. Okay. Variable overhead and fixed overhead. That's what I've just explained. Fixed production overhead should be allocated to the cost unit produced using normal production capacity and budgeted fixed overhead cost recovery rate. The question will specify the very allocating method that you will use. Either we are going to use normal production capacity or you are going to use a budgeted fixed production overhead. Okay? Then there's what we call over recovery and under recovery. Okay, if you are using normal production capacity, for example, and you will now compare it with the actual production overhead cost, you will know whether it is over or under. If what you have charged in your financial statement is higher than the one you got through your normal production capacity, then that will be over recovery. But if it is lower, that will be under recovery. We are going to see it in the next example. Then we have other costs that can come up, which administrative costs, office rentals, and all the other costs that can also be considered in determining the cost of our inventory, conversion cost, and all that. These are the costs that may not form part of the cost of the inventories, but they have to be expense in the period in which they occur. We talk about abnormal spillage. If there's abnormal spillage, for example, if in any production processes there are normal spillage and there are abnormal spillage. Normal spillage is that, okay, we talk about other waste. If you are producing a particular product, there could be some waste along the line. Some of them are considered normal. Some of them are considered abnormal. Abnormal spillage normally arises, for example, if during your production there's a breakdown of machineries, which will allow some of those raw materials to be wasted, okay? And maybe there's some incompetency from the production workers, or there's some errors or whatever that causes the wastages to be more than normal. Such abnormal spillage will not be considered as part of the cost of that inventory. Okay? Then allocation of fixed production overhead that were not allocated to production. If it is not related to production, it shouldn't be there. Storage cost, unless it is essential in the production processes. Storage cost of finished goods, for example, is not part of the cost of that inventory. If the good has been finalized, has been produced, and you are now storing it in your warehouse pending the sale of such inventory, then that cost is no longer cost of that inventory. But if in the course of production processes, there are stoppages, occasioned by, any event, and you need to store those items as a requirement of preserving those particular raw materials or the production processes and return back to the production, such storage can still be considered as part of that cost. But when the goods has already been finalized, produced, then that such storage cannot be considered as part of the cost of the inventories and administrative expenses and selling expenses and all the rest. Okay. So this, so let's look at an example of example 4.3. The company's inventory cost for the year as follows. We have the cost, the purchase price, the import duties, the shipping of raw materials to the business, manufacturing conversion cost, abnormal cost of manufacturing spoilage, storage cost of finished goods, trade discount, then required, determine the cost of inventory. Determine the cost of inventory. Before we look at the suggested solutions, I want us to do this one together. Look at these cost components. Tell me which of these, if you are determining the cost of the inventory, which of these cost that will not form part of the cost of the inventory?
One of it will be the abnormal cost of manufacturing spoilage.
Thank you very much. The first abnormal cost of the manufacturing spoilage will not be there. Any other one?
The storage cost of finished goods.
The storage cost of finished goods will not be there because we just be told now when the goods have been finished, the production has been completed, and you are now having the finished goods, and you now keep those finished goods in your store, pending when they will be sold. That cost you now come and add it as a part of the cost anymore. No. Okay. What will happen to trade discount?
We take it out of the purchase price.
Correct. Trade discount will be deducted. So it means your purchase price plus your import duties plus your shipping of raw material to the business plus your manufacturing conversion cost less trade discount of 4,000. This is going to be your cost of inventories. So if you look at the solutions, we have the purchase price, the import duty, the shipping of raw materials, the manufacturing conversion cost, the trade discount from the supplier, 4,000 will be deducted. Then the cost of the inventory will be 528,000. Okay, so this is how you determine your cost. Let's look at another example. I think this one addresses the conversion cost, nicely. Now, example 4.4. The following balances were extracted from the accounting record of Lakota Limited for the financial year ended 28 February 2021. So Lakota Limited inventories as at 28 February 2021 consist of the following. So you have the raw materials, you have opening stock, closing stock, then you have net realizable value, NRV, net realizable value. Work in progress, finished goods, packaging materials. So they give us opening stock, closing stock, and net realizable value. Now they now say the following information was extracted from the accounting record for the year ended 28 February. You have the raw material purchase, you have the transport cost, raw materials, you have the variable production overhead cost, we have the fixed production overhead cost, we have the selling expenses. Now, Lakota Limited value raw materials and work in progress according to FIFO method, which is first in, first out. Now, finished goods and consumables are valued using weighted average method. Fixed production overhead costs are allocated at 140 per unit based on normal capacity of 15,000 units that were produced. So, I told you that the question will specify how you are going to, which method we use to allocate the fixed production overhead. Okay. Now required, determine inventory to be disclosed in the statement of financial position as at 28 February 2021. Now, determine the cost of sales to be disclosed in the statement of profit or loss and other comprehensive income for the year ended 28 February 2021. We can see the questions. We were given the details of the raw material, the inventories. We have the raw materials, work in progress, and finished goods. Okay. Then we are given these three values. We have the opening stock, closing stock, and the net realizable values. Then we are given these further informations, the raw material purchase, the transport cost, the variable production overhead costs, the fixed overhead costs, and the selling expenses. So we have to determine the inventory to be disclosed in the statement of financial assets. So which means you want to determine the cost of the inventory. That is the inventory you are going to disclose. Then later you are going to disclose, the cost of sales would be for P&L. Inventory is in the financial statement of financial position. So what the question is want us to do is to determine the inventory, that what is the value of the inventory based on the information that's given unto us. So let's look at the suggested solutions. The inventory, we see the value of the inventory here, but let's now look at how these are how the inventory will sit in your statement of financial position with these values. But let's look at how we arrive at these values, okay? Let's look at the workings. Now, look at the workings here. To determine the value of the inventory for raw materials, for work in progress, and for finished goods. The opening inventory, we were given the opening inventory from the question. We were given the opening inventory for all of the opening inventory for raw materials, for work in progress, and for finished goods. We were also given the closing inventories, but we were also given all the other transactions that relate to the inventories, okay, to the inventories. So you start with your workings, you have it, your format this way. You have your raw materials, your work in progress, and your finished goods. Okay, you have it this way because once process leads to another. One process leads to another. These questions is directly related to the conversion cost. Okay, conversion cost, having your raw materials transfer it to work in progress and later becomes a finished goods. So for raw material, the opening stock, for work in progress, the opening inventory, and for finished good, the opening inventory. So when you have your opening inventories, that is, these are the inventories we have in the store. Now later you purchase, they said add purchases or transfer. But for raw materials, it's purchases. You only transfer raw materials to work in progress. Then you transfer work in progress to finished goods, okay? But for raw materials, you had the purchases. We were told that they purchase raw materials for $750. Then we have a transport cost, raw materials. This is also a component of cost of inventory. The transport cost is directly attributable to that inventory, that raw materials. So you will bring it in. Here you have hard purchases is $750. Hard other cost, which is the transport cost, is $125. Is there any other cost now that you need to add under raw materials? When you check it here, there's no other one. Variable production overhead cost. This happens in the production floor. Okay? Variable production cost, overhead cost. These are the costs that varies with the cost of production, cost of unit produced. So it's not a cost that has any to do with raw materials. So it has something to do with work in progress, production. Then fixed production cost. Fixed production overhead does not have anything to do with the raw materials. Selling expenses also does not have anything to do with raw materials. So we are done with the cost of the raw materials. Okay, here we have the opening inventory. We have the purchases, which is $750. The other cost is transport cost, raw materials, which is $125. Now, then we now have the closing inventory. We were told there's a closing inventory from the question. There's a closing inventory of 250,000. So you have the opening, we have the closing, which means at the end of the period, the stock we have in the warehouse is 250. So you will now bring your mind back and say, okay, we have opening stock of 350. We bought another goods, 750, plus the cost of transporting that goods to the warehouse, which is 125. So the total goods you have at a point in time is 350 plus 750 plus 125. Now, your closing stock is now saying 250. What happens to the balance? So the balance now, it is what you have transferred to work in progress. So the balance, we mean the materials, the raw material that has been transferred to work in progress. Okay? So that is why you put it in negative here, because when you put all this together and you remove this balance here, you now have a closing inventory of 250, which they have been given in the question. So that now move you to work in progress. The work in progress, there's also opening balance in the question. The opening balance is there. Then under the transfer now, you have a total materials worth 975,000 has been transferred to work in progress. That is what is here. Okay? Has been transferred to work in progress. Now let's consider other costs that need to be considered here in the production floor. What are the costs? We have variable production worker cost, which is 1,250. Then we have fixed production cost, which is 2,250. But the question gave us how we should allocate the fixed overhead cost. They said the fixed overhead costs are allocated at 140 per unit based on the normal capacity. So they have stated, they've gotten a standard capacity of 15,000 units to be produced. So that is how this operate. They will have set that standard. So they said you should allocate the cost based on this criteria, based on this data. So which means the production overhead we are going to allocate will be 140 multiplied by 15,000 plus the variable overhead. The variable overhead, you are going to take the variable overhead straight off, but the production overhead, which the question instructs us to allocate in a particular way, you also have to follow that. So when you look at under other costs here, you are seeing 3,350,000. This is how you arrive it. The 1,250, which is the variable cost, plus the fixed overhead cost, which you calculated as 140 multiplied by 15,000, according to the question. So the total of this gives you 3,350. So this is the cost incurred in the production section. This is the cost incurred in the production section. This is the value of the total cost in the production section. Okay, so when you put this one together and compare it with the closing stock of work in progress, which is also given in the question, when you compare it with the closing stock, you find out that this balance here, 4,274,000, is what has been transferred to finished goods. So which you can see now, the finished goods also has its own opening stock of 400,000. You can see the transfer here. This is the balance you have in work in progress, which is now being transferred. So when the raw materials were transferred here, it was processed upon, and for me, the total work in progress that has been transferred, that has completed, is this value. And the one that they are still working upon, the balance is 275,500. So this transfer will come here under finished goods. Okay, will come here under finished goods. So you can see that even under the finished goods, you have the opening stock, you have the transfer that is coming from work in progress. Then the question also let us know that the closing value of the finished goods is 3,550. So what will have happened to this one? Who can tell me what happened to this 4,319?
It's the sales.
What is this value here?
It's the sales.
Yeah, this value here is supposed to be our cost of sales. You know, this value here is to be our cost of sales. You know, this value now, this is the value that is coming. This is the goods that is coming from the production. It's coming to the production to the warehouse for purpose of selling it. It is when we now had our profit margin. When you now add your profit margin to it, you now determine the sales price. Is that not correct? So as it is now, this is our cost of sales. The goods we are going to sell, this is the total cost of it. Is that correct? Do you agree? Hello? Okay? So this 4,319 now becomes our cost of sales. That is the total cost of the goods that is ready for sale now. Okay, so when you look at this is the first part of the questions. Okay, this is the first part of the questions. Yeah, this is the first part of the questions. You can see it here. You can see the closing inventories. Yeah. Then the second part was talking about our cost of sales. The cost of sales, the one that is coming from finished goods, that is the total cost of goods that is finished, which we are going to sell, is 4,319. This one is coming directly from your workings here. Now, if you look at the fixed production overhead, there's under recovery. You remember that I mentioned under recovery, over recovery. There's under recovery. If you look at the question, the total value of fixed overhead cost charged is 2,250,000. 2,250,000 that was charged into the account is 2,250,000. But we didn't recover up to that. We didn't recover up to that. How much do we recover? 140 multiplied by 15,000. 140 multiplied by 15,000 will give you 2,100,000. So this is the amount of fixed overhead to recover. But the actual fixed overhead incurred is 2,250,000. So we are under recover, which will now be also an expenses for us. Okay. Now, you also have consumable written off to net realizable value. Consumable written off to net realizable value. You'll be saying, where is this one coming from? Let's look at this place. Now you are given three values here. You are given opening stock, closing stock, net realizable value. Now, let me explain. This question can be confusing. You know, when you are doing your measurement of inventory, you measured, you know, based on historical value. You don't measure based on net realizable value. I mean, for inventory, okay? Because their inventory, you want to determine the actual cost of it in your stock. In your stock. So you are not going to consider net realizable value. you are going to consider those costs that the actual cost, the historical cost of that materials. That is why for inventory, you are not going to look at the net realizable value at all. But for packaging materials is a consumable item. Okay, it's a consumable item. Now you look at that, we are told that the consumable item, the opening stock is this one, 71,500. The closing stock is 61,500. But the net realizable item is 65. So these consumable items we have now, if we are to dispose it right off today, if we are disposing it today, we are going to dispose it, and the closing value of it is 61,500. But we are going to if we are going to dispose it now, it will be, we only realize 60,500. So it means as we speak now, we've lost some amount of money. So that one, you also consider it as part of your cost of sales, because it's a consumable stuff. It's not an inventory. So that is why it's coming in here as consumable written off to net realizable value is 1,000. So your total cost of sales will be 4,475. So this will be, then this one you will now add your to determine your sales value. To determine your sales figure, you had your profit margin with this one, and you determine your sales. Okay, so this is how you go about these questions, these questions. So it gives you opportunity to know what are the costs, the direct attributable cost to raw materials, the direct attributable cost to work in progress, and also how you treat your finished goods. Is there any questions? So that is why you see the first question is, how will your inventories sit in your financial position? You are only going to record all the closing balances. The closing balances, which is already given in the question actually, but this is 250, 275, 335. This is how your inventory will look like in your statement of financial position. Then in your statement of profit or loss and other comprehensive income, your total cost of sales will be this one. The cost from the production, then the under recovery of your fixed overhead, then if there's any written off in form of consumables and other item that is not inventory. Okay. Then we see that this other selling expenses is not considered at all, because you can only expend selling expenses when those goods have been sold. So if you are calculating cost of goods sold, you cannot bring selling expenses in there. Okay, selling expenses will come under, after you have determined your gross profit, then other expenses like selling expenses might come to determine the actual profit. But cost of sales, it can form part of the cost of sales. So that is why you don't consider it, because the goods have not been sold yet. We are not at that level yet. Any questions? Are we good? Precious, Tato, are you okay?
Yes, I'm okay, thank you.
All right, can we continue?
Yes.
All right. So let's now look at joint cost. If you look at the cost of the inventory itself, we'll look at conversion costs, those costs that that relate with production processes. Now let's look at joint cost. Main and byproduct emanate from simultaneous production processes that result in more than one product. Cost incurred in buying live chicken, for example, slaughtering and removal of feathers by entities that sell chicken pieces are called joint costs because these are not separately identifiable to each product. This also includes the cost of cleaning and cutting into parts. So the main product, which is the pieces after cutting, may be wings, drumstring, breast, etc. Then gizzard, liver, intestine, and feet may be considered byproduct because they may have no value to the entity. So this section deals with the allocation of joint costs to each product. So I think you understand the analogy here. They are saying that if you buy a live chicken and you cut the live chicken, I mean, when you buy a live chicken, somebody will slaughter it, somebody will remove the feathers. Then later you cut the chicken into pieces. You have your wings, you have your drumsticks, you have your breast and all that. So now the cost of buying the chicken, the cost of slaughtering it and remove the feathers, this cost is like a joint cost to the main product now. What is the main joint product? These are the pieces. You have the wings, you have the drumsticks, you have the breast. How do you allocate this cost to this? I mean, there's a total cost. Like, let's say it's 30 rand. You bought the chicken, the slaughter it, the removal, the feather, the total cost 30 rand. And the actual product that comes out of there, they are wings, drumsticks, breast. Then how do you need to share this cost on this product? So that is what we are going to do here. How do you allocate a joint cost to the respective individual products? Then we also talked about byproduct. Byproduct, in this illustration here, you have gizzard, the liver, the intestine. Byproduct are product that is part of the main product actually, but it doesn't have value. It's something you can just take and throw away. So such a byproduct, most of the time, if it is valued, you will remove the value from the main cost before you allocate it to the main products. Okay, so when we see an example, it will be very easy. Then allocation can be done in different ways. You can use physical quantity to do the allocation. You can use sales value at a split point. You can use further process cost. You can use net realizable method. The questions will be very clear, okay, as to which particular allocating method you will use. It's very clear. If you want you to use all of them in the particular questions, it will also be very clear. Okay. So let's look at example 4.5. It will give us an understanding of how to handle joint cost. Now, must to be limited manufacturing process produce three main joint products, A, B, C, and a byproduct D. So the main joint product is A, B, C, and they have a byproduct D, okay? So the joint cost at split off point, the joint cost at split off point, that is at the point at which those products were splitted into A, B, C, the joint cost is 700,000. And the following productions and sales information is available. So they give us this information. We have the product, A, B, C, and D. But remember, they said D is a byproduct. D is a byproduct. So byproduct, what you normally do with a byproduct, you have to remove the value of the byproduct from the main, the cost of the main, the joint cost. You will remove it first before you allocate the remaining one. So the main product here is A, B, C, while the byproduct is D. Then you have the production. This is the actual production. We have the selling price at split-off point. We have further processing cost. We have final sales value. We have selling and distribution cost. Additional information, there were no opening and closing inventory. Now, required, determine the cost of inventory by apportioning joint cost using the following method. You want to use the physical quantity. You are going to use the sales value at a split point as a split-off point. You are going to use further processing cost. You are going to use net realizable value. So we will go through it one after the method, one after the other. Okay? They want us to determine the cost of the inventory using all these methods: the physical quantity, the sales value at a split-off point, the further processing cost, and the net realizable value. So let's look at the suggested solution. Now, like I said, the written off byproduct against joint cost. The byproduct, the byproduct is 4,000 in quantity, and the price is 3 rand per unit, per kg. So the total value of the price is 3 times 4,000. So the write-off of the byproduct against joint is 700,000 minus 12,000, which is 4,000 times 3. So it means the total value of the cost of the joint cost that will be allocated to these 3 products is 688. And the first question says we should use physical quantity. The physical quantity here, which means the quantity in terms of kg. So A is 40, 60, 90. So if you are using physical quantity, what you need to do is to say, okay, 40 plus 60 plus 90, we have a total of 190. Now, the total cost to be allocated is 688. How do we allocate it? So the way you allocate it is 40, which is for A, divided by the total quantity, which is 190. Then multiply by the cost will now give you the proportion of cost that goes to A. For B, the total quantity of B, which is 60, divided by the total quantity of the product, which is 190, multiplied by the cost will give you the proportions of the cost that is allocated to B. For C, 90 divided by the total quantity, multiplied by the cost will give you the proportion that goes to C. So when you add all the costs together, they will equal to 688. Is that clear?
Yes.
All right. Okay. So let's look at B. Pardon?
I have my hand raised.
Oh, okay. Maswala, go ahead.
May I please ask, where did you all get the 12,000?
The 12,000, you know, is the byproduct, the cost of the byproduct. We were told that the 3 main products is A, B, C, and D is the byproduct. Look at the question. It said, Moshubi Limited Manufacturing Process produced 3 main products, A, B, C.
Yes.
And a byproduct, D. So byproduct is a product that doesn't have value. So what we need to do to share the joint cost, you first of all remove the cost of the byproduct from there.
Okay. Yes, okay.
All right. So the balance, which is 688, is what we have allocated using the physical quantity. So the second question they want us to allocate using the sales value at a slip up point. You remember, selling price at a split off point. We have the selling price for A, for B, for C, okay? You want us to use the value at the selling price. So what you need to do is very also similar to what you have done. This year, the first one we use the physical quantity alone without considering the value. But now they said we should use the value. So what at a split? So what you need to do is that the physical quantity is there. This is their selling price at a split point. So what is the total value? The total sales. For A, it will be 21 multiplied by 40. For B, it will be 26 multiplied by 60. For C, it will be 32 multiplied by 90. So after you are getting the value, you will now use the same method we are using and to now add the total value together. Add the total value together. Then for you to share the 688, put 840 over 5,280 divided by 688. For B, it will be 1,560,000 divided by 552.80 multiplied by 688. For C, it will be 2,880,000 multiplied by 5280 divided by, multiplied by 688 will give you all this figure. That is what they did here. You see, 840 divided by the total value, 1562 divided by total value multiplied by 688 multiplied by 688. That's all. Is that okay? Do we get that one?
Yes, we did, sir. Thank you.
All right. Number 6 said we should use further processing cost. Okay. We should use further processing cost. You see, they give us also some further processing cost. So further processing cost. So that is what you will use again. You can see, you now put the physical quantity, we now put the further processing cost, and also multiply by 40, by 60, by this one by 90, put the total sales together. When you put it together, start putting it upon the total value, multiply by 688, you are done. Is that clear?
Yeah.
Okay. Okay. The last one says we should use net realizable value. Net realizable value. The question gave us a net realizable. You can see the question now. If you say net realizable value, it didn't. Here, there's no net realizable value here. Okay? There's no net realizable value in these questions. How do you determine your net realizable value here? Someone to tell me, how do you determine your net realizable value here? Okay? Your net realizable value. That is, if you are, it's like you having a gross profit. How do you determine if you have a gross profit? Gross profit is revenue less your cost of goods sold. You have gross profit. Then you now less other expenses to arrive at the net profit. Is that correct? Here now, you have final sales value here. But we have other expenses. If this one is final sales value, you have further processing costs, you have selling and distribution costs. So if this is the final sales value here, for you to get a net realizable value, that's the value you actually realize, you have to remove all these costs from there. Okay? So that's a little bit tricky. So that you have to know. So the net realizable value, you see how we are going to treat it now. The other one that are very straightforward. So the net realizable value, you can see, you put the physical quantity here. The question gave us a final sales value. So if you give you a final sales value, if you multiply 31 by 42, is that your actual, is that what your actual sales? Is that the sales you have that becomes, spendable in your hand? No, because there are other costs you have not taken into consideration. Okay, so that's why I'm saying that 31 minus 31 minus 8, how do you get 8? You can see. For further processing cost is 4. Under A, the further processing cost is 4. The selling expenses is 4. So 4 plus 4 is 8. For B, the further processing cost is 6. The selling and distribution is 9. 6 plus 9 is 15. Under C, the further processing is 8. This one's 8, 16. So what it means is that final sales value, you remove 8 from 31. Whatever you get, you multiply by 40. This 37, you remove 15 from there. That is 6 plus whatever you get, multiply by 60. 47, you remove 16. Whatever you get, multiply by 90. Then you now go ahead and do the allocation proper. Okay? So that is the net realizable value. You should know that. Okay? You can see here, the further processing plus selling administrative cost. We have 4 plus 4, 6 plus 9, and 8 plus. So 31 minus 8 multiplied by 40, 37 minus 15 multiplied by 60, 47 minus 16 multiplied by 90. So the net realizable value is the value, you have to remove the total cost from the sales value for you to say, okay, this is actually the sales I have. Because if you multiply by 31, you cannot say, okay, this is total sales I realize. What of the costs you have incurred? You have not taken care of the cost to be able to know what is the actual revenue you have. Okay? So once you have done that, you will now follow the same process, add the total value together, then start put each of the product on the total value, multiply by the cost, which is 688. And this is our answers. Is that clear? Are we okay?
Hello, sir.
Yeah.
Yes, I just want to know if ever we will be able to get the recording after this session.
Sure.
Okay, please, because I joined the meeting late. So
the coordinator will send it to the group.
Okay, thank you so much.
All right. Okay, another question, shall we go ahead? Are we clear with joint cost?
Okay, Dr. Obango, I just want to check, I just want to check if we treat the total further processing cost as a cost of goods sold. Is that correct?
Yeah.
Since we have a final sales value, and then it means we're gonna say final sales value less cost of goods sold. Then we get
selling expenses. Yeah.
Yeah, then we get a net.
Yes.
Okay. And then the other thing, I'm suggesting that if we can get the link through the email address, because with the phone, for me, it's not visible. I don't know.
Yeah. Okay. What you guys do is to why not send the message to the group? The coordinator will pick it up from there.
Please. Because now, some of the numbers are not clear enough.
Okay.
For me, I don't know with other students if
No. Just you guys can send I'm sure Maralize will once you send a message there that the recording link should be sent to the emails so that for easy access.
Yes.
All right. Okay.
Thanks.
Let's look at example 4.6. I think it's also on joint cost.
Hello.
Chemical Limited. Hello?
Hello.
Yeah, go ahead.
Yes, sir. I have a question.
Okay.
Did you say that with the total sales, we treat them as the others? For example, like 920,000 over the total sales times 688.
Yes.
And then that will be the net realizable value.
Yeah, that will be that is the allocated cost based on net realizable value. You know, our net realizable value now is 920 for product A, 1,320,000 for product B, 2,790,000 for product C. So the total value of the sales based on net realizable value is 5,030,000. Now, this is what we now use to allocate the cost. The total cost is 688. So 920 over 5030 multiplied by 688. For B, 1320 all over 5030 multiplied by 688. For C, 2790 all over 5030 multiplied by 688.
Okay, thank you, sir. But if I may ask, why was it not included here? Was the question not asked?
Yeah. Okay, you mean the value?
Yes.
I don't know why it's not included here, but it should be there. You should have there should have been in the other columns. There should be a column here to show us the value of those allocations. Okay, in your revision, make sure in your revision, make sure you have a column to show the allocation for each product based on net realizable value. Okay.
All right. Thank you.
Yeah. Yeah. Okay, guys, just.
Hi, Prof. Oliedi, I lost sound on my side.
He's just muted himself, I think, where he left. Yeah, he's muted.
Thank you, appreciate it.
No worries.
Okay, so let's look at another questions on joint product. Chemical Limited manufacture product based on a series of processes. The company does not hold large quantities of inventory, and a balanced level of productions and sales is usually achieved. From one process, 3 products, P, R, and T, jointly emerge in constant proportions. They proceed immediately to separate further processing operations before being sold. So the planned monthly sales of P, R, and T are 20,000, 8,000, and 4,000 liters with selling price of 2 rand, 2.10, and 0.8 per liter respectively. Okay, the joint cost related to the first process for the month in questions are raw materials, variable labor and overhead, apportion fixed overhead. So the total joint cost is 19,200. The question does not mention any byproduct here now. Okay, they didn't mention any byproduct here. So the joint cost is 19,200. Then the further processing involve no additional material, but variable labor and overhead cost of 5,000, 2,000, and 1,000 are incurred respectively for P, R, and T. Then the fixed overhead cost of this stage are allocated based on 150% of the variable labor and overhead cost of each process. So the fixed overhead cost, we were also given how we are going to allocate that one. So it's 150% of the variable labor cost. Okay? Is the 150% of the variable labor and overhead cost of each process. Required. Prepare the trading section of a statement of profit or loss and other comprehensive income of Chemical Limited for each of the three products, assuming the common processing costs are shared on the basis of volumes, which is liters produced. Then the second one, they are also shared based on the total net realizable value, that is selling price less further processing cost. Now, this question was able to define the net realizable value for you. Sales price less further processing cost. Okay. So this is the question. We were given, we were told that it involved two processes. The first processes, gave us a quantity of 28 and 4 liters. But the second processing does not actually involve any materials, so the quantity remained the same. It's only the variable labor and overhead cost that got involved, that has to be involved in the second processes. So let's go. So the question is saying, prepare a trading section where you have your revenue, cost of sales, and all that. Excuse me, please. Okay, based on the volume and net total net. So let's look at the volume first. We talk of the physical quantity now. Chemical Limited, statement of profit or loss and other comprehensive income of chemical for the year ended. Now, the revenue. What is the revenue? What is the revenue? We were given that the planned monthly sales of the product is 20,000, 8,000 liters, and we are given the selling prices. So the revenue for product P will be 2 rand multiplied by 20,000. The revenue for product R will be 2.10 multiplied by 8,000. The revenue for the product T will be 80 cents multiplied by 4,000. So these are our revenue. Is that clear? So you can see your revenue for product R, PRT. The first one is 20,000 multiplied by 2, which is 40,000. The other one, 210 multiplied by 8,000. The other one, 80 cents multiplied by 5,000 or so, or 4,000. So you can see, this is your revenue. Now you want to determine what your cost of sales is, because the question says we should just, like the trading part of your statement of profit or loss and other comprehensive income. So our cost of sales. Now, let's look at the joint cost. We have the joint cost, we have the overhead cost. We were given the joint cost as 19,200. So you have to allocate this joint cost to this product, and you have to bring it here. Okay? So based on physical quantity now, that's what we use to allocate. We can say the physical quantity. Let's look at the workings here. Physical quantity apportionment. You know, it's very easy. PRT, the physical quantity is 28,000, 4,000. It gives you the total quantity of 32,000. Now, for you to do the apportionment, 20,000 divided by 32,000 multiplied by 19,200, it gives you 12,000. 8,000 divided by 32,000 multiplied by 19,200 give you 4,800. 4,000 divided by this multiplied by this give you this. So these are your joint costs for each product. Okay, these are your joint cost. We can see our joint cost here is 13. Your joint cost is 12, 4,008, making 19,200. Then overhead cost. Your overhead cost. What will be your overhead cost? You know we have two costs here. We have the joint cost, which is 19,200. Then we have the further processing involved no additional material, but variable overhead cost of 5,000, 5,000, 2,000, 1,000. Okay. Now we have the fixed overhead costs at this stage are allocated based on 150 on the variable cost. So it means if you want to consider the two the two costs now, the variable cost is 5,000. The fixed cost is 150. The fixed cost is 150 multiply 150% of 5,000. Okay, 150% of 1,000 will give us what? 150% of 5,000 will give us what?
7,500.
Yeah, punch your calculator. Huh?
7,500.
7,500. So what will be the overhead? What will be the further processing cost now for product P? Will be 5,000 plus 7,500, correct? Is that correct? The variable labor and overhead cost is 5,000. Now you have calculated the fixed overhead cost to be 7,500. What will be the total cost for P? For P will be 7,500 plus 5,000, correct? Are you guys getting it?
Yes.
Aha. Then for R, for product R, the variable labor and overhead cost is 2,000. What will be the fixed overhead cost?
3,000.
3,000, which means the total cost, the total of both variable and fixed for R will be 5,000, correct?
Yes.
Right.
Yeah. For T, the variable labor and overhead cost is 1,000. What will be the fixed overhead cost?
1,500.
1,500. So the total cost will be 2,500.
Yes.
If you look at the questions here, we see now overhead cost. The first one is 7,500 plus 5,000, which is 12,500. The other one is 3,000 plus 2,000, which is 5,000. The other one is 1,005 plus 1,000, which is 2,005. Okay, so you have your revenue. You know how we determine the revenue. Then your cost of sales now is the total cost of joint cost and overhead cost, which is 12,000 plus 12,500 is 24,000. 9,008, 4,009. Yeah, your gross profit will be 40,000 minus 24,500, which is these figures. Is that clear? This is your this is the main. This is your trade. This is the trading section of your statement of profit and loss. Your revenue minus your cost of sales. So what constitutes your cost of sales is the joint cost. You know how we calculate the joint cost. The other one, you know how we get the overhead cost. Is that okay now? Are we clear with this one?
Yes.
Okay. Now, the other one, you want us to calculate net realizable, using net realizable value. Okay? Using net realizable value. Now, you have seen net realizable value is your sales less further cost. Okay? Your sales less further cost. Now, look at the volume. The volume, you know where the volume is coming from. You know the volume 28 and 4,000. You know the price per volume. This is the total sales. This is the total sales. Now the total cost. The other total for that, the further cost, further processing cost. You see these questions here, you see the question said, the further processing involved no additional material, but variable labor and overhead costs, this which we have calculated the other time. But when we are now considering using net realizable value, you have to bring it into consideration. We can see that this is total sales. This is the further processing cost, which is 12,000 for P, 5,000 for R, 2,500 for T. Then you now, when you remove it from the total sales, you now get your net realizable value. You now get your net realizable value. Okay, you get your net realizable value. So here, under physical allocation, instead of using the total sales, we are now using the figure you have less your further processing, which is a requirement under net realizable apportionment. So you now use your net realizable value here. Once you get this one, this plus this plus this, make it is 4 to 40, then you also use it to share your apportionment here. You know, what's it now? The joint cost. Okay? The joint cost. So when you are preparing your statement of profit or that comprehensive income under the total net realizable value, your revenue, you put your revenue here. Your cost of sales now, your joint costs now have changed because of the net realizable value method you use. Your joint cost has changed. It's now 13,002 for A, for P, 5,664 for R, 336 for this. Okay? You can see it here. Then the overcost, what's it? The overhead cost. You can see. You still put the overhead cost, you now have your gross profit here. So this is just the difference between using your physical quantity or using your net realizable value. For physical quantity, you use the physical quantity, but for net realizable value, you use the total sales value less further processing to determine for you to share the joint cost. You use to share the joint cost. It only affects sharing the joint cost. Any questions? Are you guys okay? Can we move on?
Yes, sir.
All right. So let's move quickly. Other techniques for measuring talked about the standard cost. Like measure the standard cost is the estimated or expected cost of product of inventory based on predetermined informations so it's normally set. Sometimes we use the cost formulas. We use either FIFO or weighted average formula, weighted average cost. FIFO is first in, first out, or weighted average. Let's first in, first out, weighted average. First in, first out means that whatever product that comes in first is the one that go out first. So it's the cost of the product that cost in when that particular item or inventory is going out, it go out with that cost. So the cost that come in first will go out first. But when talk of weighted average cost, you put all the costs together, then divided by the total numbers of the inventories to determine the average cost. Okay, so let's look at this example. Boy Limited was formed on 1st December 2020. The following inventory information of product T is available from accounting period. So we have this following informations. 3rd of January, they have opening inventories, 1,500 units at this cost price. Then purchases that comes in 4th of January, 24th January, 15th February, 15th March. Then we were told that 22,000 units were on hand during physical count inventory as at 31st. As at 31st, when they do their physical counting, they have 2,000 units in the warehouse. Okay? Now, the question says, determine the cost of inventory to be presented in the statement of profit or loss and other comprehensive income under the following inventory method. First in, first out, and weighted average cost. Show the cost schedule that support the cost of inventory presented. Okay. You can see that in this case now, there's no transfer or there's no sales. Okay. So they just want you to use that first in, first out to determine the cost of the inventory that they have on ground. The cost of the the closing stock now is 2,000 units based on this question. Our closing stock is 2,000 units. So what the questions want you to do is that based on first in, first out, what is the value? How do you measure this 2,000? What will be the value of this 2,000 units based on the information we have here? And first in, first out method. Okay. Now, what will be the value of this product we have here? First in, first out is the value that comes in first will go out first. But look at this question now. There's no issue of, you are not issuing out any stock. If you are issuing out any stock now, it means that the value we have in the stock here, 18,000, we have to go first, depending on the number of stock that you are issuing out. If you are issuing out total number more than 1,500, it means the first 500, the first 1,500 will go out with 18, and the next one will go out with the next price that comes, which is 30,000. But as it is, there's no issue. It's just for you to determine these 2,000 units we have as the closing stock. What is the value that will be recorded in your financial statement, in your statement of profit and loss? So we can see that out of 2,000, the value of the goods that comes in March is 1,700. Total number is 1,000, and the value is 34,000. Now, if the goods that comes in March is 1,700, and now we are having 2,000, because this is 15 March, this is 31st March. There's no other goods that comes in again. So this 1,700, the value will be at 34. Then the balance 300 will have been, a stock from 15 February. 15 February, which will be 32,000. Which means if the closing stock is 2,000, now this is another logic to it. If the closing stock is 2,000, here we have 1,700 from 15 of March. Here we have 1,000, which means the balance of the 2,000 will have come from here. So it means all the stock up to here will have been sold out. So the price now that is with us right now is that there's a 300 from this 1,000 at 32, and there's 1,700 at 34. So this is how we are going to measure our 2,000. So if we look at the question based on first in, first out, you will see that so the two prices that's available is 1,734, then the 300 will be at 32. So the inventory of 2,000, the closing stock will have, the total cost will be 67,400. Okay, so this is how you apply your first in, first out. Now, weighted average, like I said, weighted average is to put all the prices together, and all the units of the goods. So you can see from the opening stock down to 15th March. Okay, down to 15th March, we have a total good of 9,000. And these are the costs. So the total cost, which is 27, the total cost is actually 23,600. This one's supposed to be here. The total cost, you look at the unit and you look at the total cost. And for you now to get cost per unit, you now divide the total cost by the total number of units. And it gives you the average cost per unit, which is 29. If you divide 263 over 100 divided by 9,000, it will give you 29,23. So this is what we use to value our closing stock. Okay, so this is how you applied both weighted average and first in, first out to value your stock. Then another one we need to look at quickly is determine the net realizable value and recognition at a lower cost. Sometimes you also need to, they will give you some questions. Let me quickly go through the questions. You can read all this later because of our time. Look at this question. The following information was taken from financial record of Kumfela Limited, a manufacturing company. The inventory note 5, 630. Additional information, inventory at cost consists of raw materials, work in progress. Just before year end, there was damage to the storeroom in which some inventory was stored. The damage resulted in 40% of the raw material being damaged. It was determined that the net realizable value of the raw material that was not damaged was 15% below the cost thereof. None of the work in progress was damaged, and the net realizable value of the work in progress was estimated to be 280. Value the inventory as at 2019, determine the value of write-off that must be. So what you need to do is to this will just address the additional information here. We were told that the damage is 40% of the raw materials damaged. And even the, the remaining materials, what they can, it was determined that of the raw material that was not damaged was 15% below. Even the one that was not damaged was 15% of the cost. So it's a reduction in the value. So the raw materials is 380 multiplied by 60 times 85. You know how you get that one now. The raw materials is 380. It's 380 here. Then we were told that out of 380, 40% was damaged. So we only remain 60%. And that 60% that is remaining, only 85, the value now have dropped to 85%, no longer 100%, because we are told that the net realizable value of the raw material that was not damaged was 15% below the cost. So if we have 40%, 60% left of the raw material that is not damaged, that 60% also, the value has also been reduced by 15%. So that's what they did here. The 380, first of all, is multiplied by 60%. Then multiply by 85%. That is the less 15%. You arrive at this. The work in progress is okay. We are told that the work in progress, nothing happened to the work in progress. None of the work in progress was damaged, and the net realizable value in progress is estimated to be 280, or to be 280. Remember, you are to determine the cost the cost must be determine net realizable value and reckoning of the lower of cost. So it has to be, the cost has to be the lower of cost and net realizable value. When you look at the net realizable value and you look at the cost, you have to pick the lowest, the one that is lower. So when you look at this one, we were told this is the work in progress, is 250. But we were told that nothing happened to it, but it was the work in progress. The net realizable value was estimated to be 280. What's the difference between, which one is lower between 250 and 280 is 250. Okay, so that's why the 250 is picked here, because you are picking the lower of cost and net realizable value. Then this one also will Hopman extracted the following balances from financial record. The inventory at cost is 68050. The cost price of the inventory on hand consists of finished goods of this, work in progress of this, raw materials of this. The net realizable value of finished goods to be 10% below the cost of finished goods. The net realizable value of the raw materials and work was able to be the same as cost. Inventory is recorded at a lower of cost and net realizable value. I want you to work with this one. We were told that the inventory is recorded at a lower of cost. So you have to consider the cost and consider the net realizable value. The one that is lower, that's what we are used to use to determine the cost of the inventory. Okay, you see the solutions here. Then the last one you can also practice with it is just talking about lower of cost and okay, this one I talk about the disclosure and all that. Okay, here you are going to determine, just use this as an example for practice. It's just for you to determine, this one you have to determine the cost of the inventory based on lower of cost and realizable value. So you will look at the cost. You will look at the cost and see in between cost and the net realizable value. You will now select the one that, if in this case, packaging cost, if it is cost that is okay, that is lower, you pick it. The other one, if it is net that is lower, you pick it. That's why you do it, and you put together to determine the cost of the inventory. Okay. The same thing in question 2. Look at this one, dog basket. We have small. Here is 18,000, the cost. The net realizable value is 20,000. So you are going to pick 18,000 here. For large, here is 28. The net value is 24. You pick 24 here. So you are do like that and put together and determine the cost of the inventory. Okay. So this is your inventory and how you measure your inventory, based on the various methods that we have talked about tonight. Any question?
I don't have a question regarding the information provided. What I do want to know, you're going to also have Teams discussions on the other subjects of this module? Property, plant, and equipment more specifically. I'm asking, I don't have questions based on the information that we discussed. What I do want to know, are you also going to have a team session around property, plant, and equipment?
Team section and what? Your line is breaking.
So what I want
team
to
section
know
on what?
Is there going to be other teams sessions besides this one?
Yeah, we are going to be meeting every Tuesday.
Okay, thank you.
Every Tuesday and Thursday. Thursday is for 2602.
Okay, that's what I wanted to know. Thank you.
All right. Okay, guys. Okay. Masala, go ahead.
I have another question.
You can go first.
Hello, Bridget.
Sir, I wanted to ask, have you been I'm busy with other team sessions because it's only now that I get to know that they are classes.
No. We just started today.
Oh, I was wondering why we started with topic 4.
Yeah, because those other ones, majorly theories, which I think you'll be put through by your lecturers on financial reporting. I mean, your financial statement and all that. So I just felt that we could start from here, and but I don't think you are going to have those. The first 2 learning unit is discussing the IS1, which is the financial statement, the statement of profit or loss and other comprehensive income, the statement of financial positions and all that. So, except that if you have any issues, around that, then we can discuss at any point in time.
Okay, thank you.
Yeah.
Good evening, Prof. Just to confirm, you stated that Thursday there's going to be another class for 2602. Will it be similar to this class, or will it be something different? Because I've got both modules. I've got 2601 and 2602.
Yeah, on Thursday we'll be dealing with 2602. On Tuesdays, 2601.
The Thursday class will also be AIS 2.
Yeah, Thursday class is 2602 from 5 to 7.
Thank you, sir.
All right. Okay. Magwaba.
Can you please send the link for the Thursday class as well for the 2602?
Yeah, they will send it. The coordinator will send it.
Okay, thank you, sir.
All right. Okay, guys. See you on Thursday.
Thank you, sir.
Thank you.
Yeah, bye.
Thanks. Bye.